have come with the explanation module 9.6 for computation of capital gain. I told you we have learned theoretical concepts, how to compute long-term capital gain, short-term capital gain, then all the sections under section 54. Different sections we learned. Section 54, section 54B, section 54EC, section 54D, 54G, 54GA and GB. So I told you one important section we are going to cover, that is this module, that is section 54F. So this section is very, very important. When you will get full computation of capital gain problem, always this section will be there, because this calculation is little tricky. But I have explained two problems and the second problem has one more calculation. So actually we can say that though it's only two problems, I have explained three problems. And the one problem, complete illustration. Very thoroughly I have explained step by step how we are going to calculate that. So once you learn that, then that's very sure that you can get, I am very sure that you can get the marks, full marks, you can score full marks for the examination question. And you can learn that also. Very simple way I have explained. So please remember that this section is very, very important. And only one more module is left in computation of capital gain, that is complete problem solving. That is with all the sections. It will be a mixture of all the sections. So that is how we are going to do that. And please remember that this section is very important and we are going to learn that. And I have made it in a very simple way. Section 54F, capital gain on transfer of a long-term capital asset other than a house property. We have learned that if they are selling a house property, residential house property, if they are getting any exemption, they can claim that exemption using section 54. So that in detail we have learned that. So if the assessee is selling any other long-term capital asset, please remember that short-term capital asset, this adjustment is not possible. Only for long-term capital asset. It can be a plant, it can be land, it can be plant and machinery, it can be a vehicle, it can be jewelry, it can be shares, anything like that. So anything other than a house property, if an assessee, if he has used for a long term, that is usually in the case of 3 years. So then it will be, he can claim this section, which is very good section to claim to reduce the tax liability of the assessee, section 54F. So conditions we have to see that only an individual or HUF can claim this exemption. So please remember that some sections we have learned that all assessees can claim. But most of the sections only an individual or HUF can claim this exemption. Second thing you have to remember, I already told you short-term capital assets, this benefit cannot be claimed. So only for long-term capital assets can be claimed under section 54F. Next is, it should not be a residential house property. If the assessee is selling a residential house property, he has to claim the exemption under section 54, which we have learned in module 9.3. Now, this what all other than residential house property, what all can come under section 54F? So it can be a plot of land, commercial house property, gold, shares or any other asset. So I told you all this can be examples: commercial house property, plant and machinery, vehicle, jewelry, gold, antiques, paintings, anything like that. Other than residential house property, it can be anything which is held by assessee on a long term, for a long term. It's a long term capital asset. Now what is the exemption available? Taxpayer should purchase a residential house property, old or new, or construct a new house property. So this, you remember when I explained section 54, I have explained 1, 2 and 3. So when it's for a residential house property, if they are taking a decision to buy a house property 1 year before, so that is one thing. I have explained how they can take a decision 1 year before. You can do the initial investment, then you can start paying that. Then still your house property, present house property may not be sold. So 1 year before you can take the decision, or 2 years after selling the house property. Or the next point is the same condition as of section 54. Construction of new house property within 3 years. So 1, 2 and 3. This condition will be applicable for section 54 and section 54F. So that is why I am repeating this. You can remember like this. Now exemption is available only if on the date of transfer of the original asset, taxpayer does not own more than one residential house property. So that is very, very important. The taxpayer, if he has got any other residential house property, he cannot claim this exemption. So always in all the problems you can see that this condition will be there. If you have to apply 54F, remember this word will be there in the question. He does not have any other, he does not own any other residential house property on that date. That meaning you have to decide section 54F will be there in the adjustment, because it will not be clear. Question may not say that which section you have to apply. It's your understanding and it's your common sense you have to use. So if this condition is there in the question, it's a hint that you have to apply section 54F. What is the hint? That assessee does not own any other house property on the date of buying the new asset. Now, amount of exemption available is calculated using the equation LTCG into amount invested for new house property divided by net consideration. This I am going to explain in detail with the help of problems. LTCG, you know that long-term capital gain. That when we will do, we will get the question. When we will do the solution, we will get that. Sale consideration minus expenses on sale. That is the net consideration. So net consideration value is there. That you have to do, take it from the solution, and amount invested for new house property will be there in the question. So LTCG we are deriving from the solution. Net consideration, net sale consideration also we are deriving from the solution. But the other amount is given in the question. Amount invested for new house property. Now capital gain account scheme. So every section they can, if the assessee is not able to buy the new asset within the time period, so they got that option to invest in the capital gain account scheme. So what is capital gain account scheme? Already we have seen that. Again we are repeating. Amount of net consideration which is not utilized by the assessee for the purchase or construction of the new house. Imagine that I told you it's very difficult to decide which property to buy. So many constraints will be there. Children's education, spouse working place, our working place, religious places we have to visit, closeness to the city, travel time, closeness to the many things we have to consider. All these things we have to consider: hospital facilities, police facilities, whether it's a safe place, whether it's a fully developed layout. So all these considerations we have to see. So it will take time. So sometimes if you are not able to buy a new asset within the time period, what you have to do is you have to deposit that amount in the capital gain account scheme. So before the date of furnishing the return of income, whenever you have to. Now this year due to lockdown, the submission date for income tax filing rate is extended till November 30th. Usually it is July 31st. So whatever the date decided by the income tax department and central finance minister, that date, before that date you should deposit that. Now it shall be deposited by him under the capital gain account scheme before the due date of furnishing the return. So due date of furnishing the return can change sometimes. But this you have to remember that we have to do that. Before filing the date of return, the amount should be deposited in the capital gain account scheme. Now, exemption is not available. Again, I am repeating. If the assessee owns more than one residential house property. So, I told you the hint also. He does not own a residential house property. That is how from the problem we will make out section 54F will be applicable. So, the condition again is repeating. If the assessee owns more than one residential house property. Now, if he is purchasing another new house property other than the new asset within a period of 1 year, or if he is constructing a residential house property other than the new asset within a period of 3 years. So, here it is 1 and 3. Earlier, exemption available I told you 1, 2 and 3. The time period given for buying the new asset. Same as section 54. Here it is exemption. The condition is purchasing a residential new house property within 1 year of buying this new asset, or 3 years for construction and 1 year for purchase. So that is the exemption is not available if he is doing that. If he is again buying a new asset within this time period. Now, any income from such residential house other than the one residential house owned on the date of transfer of original asset is charged under the head income from house property. So this is like a punishment. Whatever extra income you are getting, it will be taxed under income from house property. Now, consequences. First point is, if the new house is transferred within a period of 3 years of its purchase or construction. See this, you are claiming for a long-term capital asset. The new asset purchased also, you have to keep it for 3 years. Before 3 years, if you are selling the new asset what you have purchased, consequences are there. So, capital gain or loss on the transfer of new house will be charged to tax under the head capital gain. So that capital gain tax you have to pay. Whatever you have claimed earlier, that you have to pay tax now. Now, capital gain exemption claimed earlier under section 54F shall be treated as long-term capital gain of the previous year in which new asset is transferred. So, two consequences are there. New asset when you are selling, it's short-term. So, short-term capital gain will be there. Earlier you have claimed a long-term capital gain. That also will be there. So, both you have to pay tax. Now, two problems I am going to do. I told you one problem is complete explanation. The second problem, I am going to divide it into two. So that it's in effect, we are doing three problems. So first problem, Mr. A sold the following assets during the assessment year 2021. Usually this type of one question you can expect for section C at the undergraduate level. So this problem, its calculation is very simple. But you have to relearn it in the systematic way. Now, he purchased a house for rupees 22 lakhs on 1/6/2020, 1st June 2020. He did not own any other house on that date. Compute his capital gain. See this question, I told you it's not mentioned in section 54F you have to apply. It's not mentioned. But how do you know that section 54F is applicable? It's mentioned in the question that he did not own any other house on that date. Now the assets sold are given, listed securities are there, silver is there, jewelry is there and shop is there. So date of acquisition, different dates are given. Then CII. For silver it is not there because silver is purchased in the year 99. You know that our base for indexing is 2001. So only for silver we have the fair market value. Other assets are purchased after 2001. So fair market value will be applicable only for silver. Now date of sale is given, fair market value only for silver and sale price is given. Now we'll see how we will calculate this. This table is the complete calculation. The computation is going for the next slides. So sale price is 2,60,000, 15 lakhs, 6 lakhs and 11 lakh 50,000. These values are there in the question. Now less expenses on sale. It is not there in all these cases. I told you why we are doing this. You have to remember that if that item is there because it will be small amount. If we have not reduced that at the first step, or entire calculation will go wrong because net sale consideration value should be correct. So this, even if it's there in the question or not, less expenses on sale should be provided in the solution. In the statement you learn as it is. So you will not make a mistake. So net sale consideration, same value as the sale price. 2,60,000, 15 lakhs, 6 lakhs, 11 lakh 50,000. Now, less index cost. Now you know that how we can calculate the index cost. I have explained index cost calculation in the next slide. So you can see that how each item. See, only for silver we are taking the 2001 value. 2001 value and all these problems we are doing the index cost. So all these values, next slide I have given how I got these values. Now you will get long-term capital gain. See, long-term capital gain is net sale consideration minus the index cost. 2,60,000 minus 1,80,000. You will get 80,000. Next is 15 lakhs minus 12 lakh 4,000. You will get 2,96,000. Next is 6 lakhs minus 3,70,000 81. You will get 2,29,919. Next is 11 lakh 50,000 minus 9 lakh 46,000. You will get 2 lakh 4,000. Now exemption under section 54F. Now how I got these values, I have to go to the next slide because I have explained clearly. Now index cost of silver, I told you I have explained in this slide how you got 4 lakh into 301. That is the index value for this year divided by 100. Because silver fair market value as on 2001 will be applicable. So you are getting that value. Index cost of jewelry 1,50,000 into this year index is 301 divided by year of acquisition 122. You are getting 3,70,081. Now index cost of shop is 3,30,000 into 301 divided by 105 9,46,000. Now calculation of exemption under section 54F is explained in the next slide. See, here you have to remember that. See, the question is he has invested 22 lakhs. 22 lakhs. If you will see the sale price of total assets, 4 assets what he sold, that whatever sale price he got is more than 22 lakhs. That meaning he has not invested the full value. See, some problems when I will do in the next module, I have explained that full value, whatever net sale consideration he has invested in new asset. Then you don't have to do the calculation. It's very simple. Full value, that I will tell you how to do that. But here you have to remember that you take the sale price of all the four assets. That is the first line in the solution. If you add up all that, it's more than 22 lakhs. But in the question, it says that he has invested only 22 lakhs for the new asset. So we cannot allow the full exemption. It will be always a percentage. So how you calculate which asset will get the maximum exemption, which assets are not going to get. How you calculate? You have to calculate LTCG into LTCG, percentage of LTCG to net sale consideration. LTCG value calculated in the solution. Securities 2,60,000 minus 1,80,000. So it is 80,000. Now net sale consideration, because there is no expenses on sale, that is the sale price itself is the net sale consideration. So 80,000 divided by 2,60,000 into 100. You are getting 30.77%. Second item also, you have to take the values from the solution and you have to calculate accordingly. 2,96,000 divided by 15 lakhs into 100. You will get 19.73%. Jewelry, 2,29,919 divided by 6 lakhs into 100. 38.32%. Shop, 2,04,000 divided by 11,50,000 into 100. You will get 17.74%. Now, see, rating you have to do. So what is which is the highest percentage? Highest percentage is for jewelry. Second highest percentage what we calculated in the last slide, your securities is getting second percentage. Third, silver is getting, and fourth, shop is getting. So whatever capital gain first we are allowing, we are going to give it to jewelry. Then we will see securities. Then we will see silver. Then we will give it to shop. So this is how we are going to do the calculation. So that is what I have explained. First exemption under section 54F will be allowed to jewelry, followed by securities, silver and shop. Now, new investment in the houses, it is given in the question 22 lakhs. Now this investment is more than the net investment of jewelry. So this jewelry sale price is 6 lakhs. So therefore entire LTCG from jewelry is exempted. So you can see in the solution, jewelry will get the complete exemption. Now this balance investment we have to see. 22 lakhs is the new investment. He has already claimed jewelry 6 lakhs. Now balance amount is 22 lakhs minus 6 lakhs. You are getting 16 lakhs. Correct? Now this amount is more than the net investment in securities. Sale price for securities is 2,60,000. So now LTCG for securities is also fully allowed. Now you have to see that balance investment is 16 lakhs minus 3,60,000. We are getting 13 lakhs 40,000. But this is less than the net consideration for silver, that is rupees 15 lakhs. So we cannot. So first two items, securities and jewelry got the maximum full exemption. Now the third one, silver is not going to get the full exemption. We have to calculate the percentage value. And shop is not going to get at all. Shop full LTCG will be taxed. So this is less than the net sale consideration for silver, that is 15 lakhs. You can see that what price silver is sold. Then LTCG is exempted as the percentage value calculated using the equation. Remember the equation I told you? LTCG into amount invested for new house property divided by net consideration. LTCG value and net sale consideration you will get from the question solution. Amount invested for the new house property will be there in the question. Now exemption. Using for silver, 2,96,000 is the LTCG. Balance investment available. 22 lakhs we cannot take. So two items we have already adjusted and balance is 13 lakhs 40,000. Now net sale consideration is 15 lakhs. So 2,64,427 will be allowed. So capital gain for shop will be fully taxable. So that is the solution. Solution, you can see that these items. This is how we have taxed and that is how we are doing that. This is the simple step. If you learn this step by step, there is nothing like that. It's very simple. Now, next problem. This has two sub questions. So first one and the second one. So that is why I told you in effect we are doing three problems. Mr. X provides the following information about the sale of his residential house property during the assessment year 2021. Compute the taxable capital gain. See, here also it is not mentioned. Section 54F is applicable. So house property purchased in 1988 for 15 lakhs. Remember that we will not take that value, only fair market value as on 1/4/2001 we will take, that is 62 lakhs. Sale price 30/10/2019, 2 crore 80 lakhs. Amount invested in purchase of new house property in April 2020. You have to remember that within 1 year before they can buy, or 2 years after sale they can buy. So this October he purchased this, sold this, and he's purchasing within November, December, January, February, March, April. Within 6 months he is purchasing. So he is eligible for exemption. Now compute the taxable capital gain. Now the second sub question, Mr. X also acquired a plot of land on 30/6/2006. CII is 122, because that we have to use for indexing, for 75 lakhs, and spent rupees 2,85,000 for registration charges. Please remember that registration charges will be added to the cost price. This plot was sold for 2,10,000 on 30/6/2019. So that is 301. He purchased a house for 40 lakhs on 1/8/2018 for his residence. He paid 50,000 as ground rent for the plot held by him. Compute the capital gain tax payable by Mr. X for the assessment year 2021. Now we are doing the computation. Table showing the computation of taxable capital gain of Mr. X for the assessment year 2021. Sale price 2 crore 80 lakhs. Expenses on sale is not there, but just to teach you that step, I am using that. Net sale consideration is 2 crore 80 lakhs itself. Index market value. We will not take the value 1988 value, we will take the 2001 value. 62 lakhs into 301 divided by 100. 1 crore 86 lakhs 62,000. Now LTCG is 93 lakhs 38,000. Now less amount invested in the new house property. It's 80 lakhs. In the question it was given as 80,000. Please remember that it's 80 lakhs. So taxable LTCG is 13 lakhs 38,000. So this is how you will calculate the taxable LTCG. This is section 54. He is taking the exemption because he is selling a house, residential house property. Here we are not using 54F. 54 exemption he is claiming. So 13 lakhs 38,000 he has to pay tax LTCG. Now we will come to that 54F. Now remember sale price of plot 2 crore 10 lakhs. Now expenses on sale is nil. Net sale consideration also 2 crore 10 lakhs. Now index cost is 75 lakhs into 301 divided by 122. So he will get 1,85,000, 4,098. Now LTCG you will get net sale consideration minus index cost 24 lakhs 95,902. Now less exemption under section 54F. So he has already only one house. One house he sold and one house now the new house he has. So he can claim 54F. Now how we will claim 54F is we have to use the equation. That is exemption under section 54F. 54F is 24 lakhs 95,902 into 40 lakhs divided by 2,10,000. So this equation I have given here. So that values I have substituted and we are getting 4,75,410. Now taxable LTCG is 20 lakhs 20,492. One important thing you have to remember, ground rent 50,000 is given in the question. It is a revenue expenditure. This we are calculating the capital gain. It's capital expenditure only we will consider. Ground rent we will not allow in the computation of capital gain. So this is the module I want to explain for explaining section 54F. So next module is full computation of capital gain questions. So there I have used different sections. It will be a combination of 1 or 2 sections usually. So there I have explained clearly how section 54F can be applied. So this is also important. Section 54F. First problem I have explained each and every step how you calculate. Please understand that steps clearly, then you cannot make any mistake. So now we are going to the last module, that is module 9.7, where I am going to explain 6 problems for computation of capital gain. So when we will do that, you will be thorough with the computation and the theoretical concepts also. I'm making it very simple and I'm teaching you in the systematic way, which I told you I learn from my students how they will understand. When I face a face to face class, I can understand how my students will take it. And they're very smart. My Christ College, my Christ University students are very smart. If you're doing something wrong, they will criticize us. If you're doing something good, they will say, they will be happy also. They are very open. They will tell us, see, this is what, ma'am, you have to improve, ma'am, you have to do this. So these are all things I learned over the years of experience. So this is the same thing I'm sharing with you so that the students throughout India, let them get the benefit of learning this subject, which everybody is thinking that it's difficult. But it's not difficult. I'm telling you, it's not at all difficult. You can score maximum marks. So happy learning, and I am going to put all the links, the entire income tax syllabus in the educational video, Alice Mani educational video. So you can see the video and you can subscribe and you can learn that using that video, and you can tell me your feedback, suggestions so that I can improve and I can be a better teacher. Thank you. Stay safe and stay healthy and keep the social distancing. Follow the government norms. Be healthy. Be safe. We will see with the next module. Thank you.